Hello, this is Pat Walker at MissionWinners.com, and it is Saturday afternoon. And I'm doing a video here, and you can say, well, Pat, where's the charts? Where's the pictures? And at times, I think it's good to show charts, but sometimes I think it's better that we just focus on what somebody's talking about. And so I'm going to ask you if you would. This to me is a great quote, a great thought by Sir Edmund Hillary. Sometime if you ever want me to, I'll tell you a story about Sir Edmund Hillary and Tenzing Nortag that I find quite interesting, to tell you the truth. Anyway, I love to go through Investors Daily, and I save old articles that are life-changing for me, possibly life-changing for you. This is, I'm going to do this short and sweet, and I'm not going to read this whole thing to you because you don't want to hear that. But this is from Friday, July 18th, 2014. This is the Investors Corner. And what the headline says is, huge quarterly EPS growth precedes big price gains. And it goes through and it talks about studies of winning stocks during bull markets and what they can do. Talk about, what are they looking for as far as minimum earnings. And folks, my point is this. We're trying to develop some rules to help narrow down our focus on what to look at. By so doing, it increases our odds, if we have good constraints, that we're going to find some great winners. So here's what they say. Cancelim Discipline looks for earnings growth of at least 25% or higher for the last quarter. Triple-digit gains are best of all. Here we go, folks. Check this out. Apple had quarters of 300 and 433% earnings growth just before it broke out in March of 2004 and began a colossal advance. Google had earnings of 112 and 123% just before the stock started its advance in August of 2004. I'm going to say those numbers again. Apple, 300% increase in earnings, 433% increase in earnings. Google, 112% increase and 123%. Those were the earnings numbers before they made their big move. A study of the 600 best performing stocks from 1952 to 2001 showed that the average earnings increase before the stock made its big move was 70%. I'm going to read that again. A study of 600 top performing stocks from 1952 to 2001 showed that the average earnings increase before the stock made its big move was 70%. That's huge. That's what we're looking for. They give a list of some fast profit growers in previous times, and the numbers are, well, I'll just tell you. Fairchild Semiconductor, way back when, 1,900%. Micron back then, 1,875%. Spansion, the ticker symbol was CODE, 500%. Diamondback Energy, way back when, 342%. My point is this. If we really want to increase our odds of making money, research, solid, unbiased, quantitative research shows you increase your odds when you look for companies that have great earnings. Are there exceptions to the rule? There's exceptions to every rule. But if you want to stack the deck in your favor, why don't we focus on companies with great earnings? This is from Investors Corner, Friday, July 18th, 2014. And I hope that helps you. That's why we have some minimum earnings constraints on our screens. And I thank you, and y'all have a good night.